Welcome everyone. Welcome to today's section. Now I know you guys already know this, those who have been with us for a very long time. But once in a while, it's good to refresh your memories on things like this as well, because we pick POIs every day, and it's not easy trying to spot another block or a breaker block from a chart made out of order blocks and breaker blocks mitigation. So it's not easy to spot the right one. So it's good to also refresh your memories once in a while on the knowledge. And I thought about it and I said, okay, maybe we should do something to bit about the top-down details. Excuse me. Still have my cough. I haven't really fully recovered yet. So show you guys how to pick that high time POIs again from the top, and then not just higher time frame POIs, refine them to the lower time frame and make sure you're not doing the wrong thing, all right? And make sure you also know how to know when this POI is likely to hold, it's having a high probability, why you should go, or why you're having a reasonable reason you want to go high risk on this. And taking us back to the monthly time frame. Now, this is a time frame which I don't, probably look at all the time. I don't look at this time frame all the time because I'm more of an intraday trader. I don't swing these days because of the weird price action we have. As you can see, for the whole of the year, I can say market has been really, not giving a clean retracement into a swing POI to hold your trade for a very long time. Is either doing something like this in a swing POI, then coming back up when you're waiting for a POI to get mitigated, then you see something like this instead, and then you get left out, right? So instead of me getting trapped and trying to determine if this is a high probability POI or what's taking my trade, or should I wait for my original POI and see this as an inducement, what I do is that I just scalp my way around it, from here to here. I'm out with about 3 to 4%, of my accounts, and I'm looking out for the next retracement. All right, so I decided to start scalping my way through the trend instead of trying to actually, ride the entire trend hold down, because at the same time, something like this could happen. Price clear at that same low, and then we turn back to, kick us out, even if we do pick this POI, and then we end up not making any money at all. All right, so always make sure you know when to scalp, and you also know when to swing trades as well. For me, I say it's not really a good month. And the previous 2 months haven't been really the best. The second quarter of the year is actually very, very flexible, when it comes to price action. So it's easier to spot clean POIs then and hopping on nice trades than now. March, April, May, using ICT's knowledge, you understand that this is a very complicated period of time in the year to trade, and it's very difficult to follow the high time frame trend. Right, it's always on steroid. It's either going down or it's going up. There's no formal structure movement that you can really capitalize on. So instead of missing out on trades and getting in on POIs that you can get stopped out, or which are not trustworthy enough to have enough money or equity on a particular trade, it's just too risky. It's just too risky. So for that case, I have been on the weekly time frame for a very long time. So I have a logical reason why I don't look at the monthly, not because I feel like all details is on the weekly. I do look at the monthly once in a month, once or twice in a month. I get my direction for the month and I'm out, because I'm not planning to swing. I'm just scalping. So now on the monthly, what do we see? All right, so we had a breakout structure here. All right, price was in a bearish form, right? And then what do we see? Price mitigated the week of this monthly zone. Not this guy. We have this. This was the mitigation coming from this structure. This was the structure, the monthly structure, and this was the mitigation. So from here, we're expecting something like this. But then what we had a stop hunt, not a stop hunt, we got stopped out because this is clearly bullish. This is clearly a bullish structure, and price just broke out. Okay, no, so that's what the monthly can say. The monthly was supposed to be bearish, but then we're still bullish, clearly very bullish. And we have a weekly range within the monthly structure, which is something like this. Now within this range, what do we see on the weekly time frame? One minute. So on the weekly time frame, we can see clearly that this are now being used as liquidity. All right. So we see price booking that out. They've been stopped out. I don't think anyone is still here, but let's say people are trading, maybe the position traders or very, very long-term traders, because this highs were created around 214 or I don't know. I think it's 2022 April. All right, so around the same time last year, a year ago. So I'm guessing there's liquidity for swing traders, and then we see a stop point of that high. This structure has been invalidated. All right, so this structure has been invalidated, and now we're seeing bullish. So we could see gold doing something like this. All right, this could be that. And then let's see how the 3-month time frame is looking. Now I'm doing this to give you guys a formal way around the monthly time frame, just to remind you how we do it. And also, this is the best way you can pick a higher probability POI, is by following the higher time frame. So on the monthly, this is what I do on the monthly time frame as well. I don't really go to the monthly time frame to look for another block or to follow a break of structure or something. I always go to the monthly time frame to make sure I'm looking for a formal structure, which is giving me the direction, not an entry, but the direction. The POIs are going to be scouted on the weekly time frame because I'm trying to. Well, so this is the 3-month time frame. What do we see? So if I was to ask anybody randomly, if it could tell me what do you see on the 3-month time frame, looking at the overall structure of gold, what do you think is happening over here?
I was gonna say stuck in a range at the moment.
Yeah, that's true. On this range, we see price has been here for about so this was January to 20. Is that 2012? Okay, that is January 2020. So that was 2020. This was a range that was created in January 2020, and the price has been accumulating within this range for this period of time. Now, this accumulation has been happening within the bullish structure of the monthly time frame. This is the 3-month time frame, and then after we had a break of structure, this range has been happening within the premium level of the market, and clearly we see it hasn't broken out yet. This is still a week, and it's not bearish, it's not bullish. On the monthly, it's ranging. On the 2-month time frame, it's ranging. But if we do compress our view to go closer, what do we see? Let's point out the key levels within this range. Price has been within this zone since 2020, and then we're trying to trade. This is May. We're trying to trade within a week in the month of May around 2022. So with this information, we know that 2023. Sorry, with this information, we know that we don't need all this data, but we do understand that gold has been in a range on the premium side in a bullish structure. This is crazy. But at the same time, what we can do, the highest we can do right now is just to pick out the key levels within the 3-month time frame that we can clearly see. All right, I would explain why I'm picking these levels, and hopefully you understand them by then. All right, so what do we see? These are the levels within the 3-month time frame on the range that we expect price to react from. Now, as you can see already, the closest range, is already being mitigated right now. So if price is already bullish and is about to break out of this range, it's trying to break out of this range, the retest of this level could be possible. The retest of this is possible. This is also a breakup block. So we can see something within this because as you see, this is still like a fair value gap, right? And the breakup block in between it. So price could just do something like this and then go back up. But at the same time, this is also another block, right? So now I told you guys when marking another block, what do you expect? We have two POIs within another block. I told you guys there's one at the opening, right? And one at the 50%, right? I've made mention of that multiple times, right? So understanding that, how many other blocks do we see on this time frame? We see there's another block here. Right, as this is another block, we got invalidated, but it doesn't change the fact that it's another block. This is also another block. All right, just created. This is also another block. Okay, now where is the opening of this other block? We have that right here. There's a wick. Obviously, on the lower time frame, there'll be another block within the wick, right? Because the wick is also a POI. Told you within the wick, either the opening of the wick or the 50%, because it's also another block, right? So on this other block, this was supposed to be what? A bearish or a bullish other block. It was supposed to be bullish, but also got invalidated. Price broke out and then came back in. So this other block got invalidated. But at the same time, if you use the line chart, you will see the structure. We see this. All right, so there was a stop hunt here. So everything below this, is a manipulated zone, which is also called a key level. All right, there could be a reaction from this. It's like the QM level, and price goes back up because this is a QM, a perfectly formed QM. So that's also a key level. When I mean key level, I mean any possible place you see price could react from within that particular zone. So when they say mark the key levels within the zone, you should be able to understand that they don't just mean mark out the other blocks within that zone. Mark out every possible point of that zone you think price can react from. All right. So I'm going to delete this again and put on the candlestick. And now, if I say on the higher time frame, you're not expected to mark out POIs. All right, you're expected to mark out key levels. So when you're on the higher time frame, you don't mark out point of interest or any level you're interested in. You mark out key levels, and then on the lower time frame, you mark out points of interest within those key levels. All right, so making sure you know how to mark out those key levels in the higher time frame gives you that understanding of a high probability POI. Because when you mark out the key level from a monthly time frame, or a 3-month time frame, or a weekly time frame, and you're being able to identify, the key levels within those, the POIs within those key levels, it gives you an understanding that any other POI which is created outside those key levels are low risk. You understand what I'm trying to say? So those are low risk. So if your POI is, let's say, you had a structure like this, okay, and then you have a break of structure from here, you have a POI over here, and then you have a POI over here. And then we say you had a check on the monthly time frame or the weekly time frame, and you saw the overall weekly structure was looking like this. All right, and the key level within the monthly time frame on the weekly time frame, sorry, is here because we had the break of structure here, and then we had another block around here. All right, but on the daily time frame, you have a POI over here. Okay, and then you have a POI over here as well, but there was no POI over here, just a fair value gap. This gives you an understanding that this should be your overall POI and is actually the high probability POI. This could give you a reaction because it's a fair value gap within a weekly key zone. But this right here is likely an inducement to this POI because it's not really significant in the higher time frame. You get what I'm trying to say? So and then you can also confirm this using the Fibonacci level, but I see that as no use if you really know how to identify this, because if you mark this out properly, you will see those zones out clearly. So and it's better when you have a logical explanation of the zones than just trusting a tool, which is created to follow some certain rules. That might not be your system of trading, and you might get trapped, on a trap. Do you understand what I'm saying?
Yeah.
So this is more reasons why it's very important to know how to pick the key zones on the monthly time frame. So now, sorry, that was not meant to happen. What do we understand? We understand. Let's take this all out. Back to the whiteboard. Now, pay close attention to this. Key levels. A trend is formed in this form. Okay. So now what we understand is that a trend is formed in a zigzag line, and which is, what we call the trend. The trend is your friend because the trend can only do, price can only do two things. Either move forward or it's moving backwards, which is the up or down. All right. So it's either going up or it's coming back down. Now, it's more like kind of like key levels are those levels price reacts from. Now, this point has this reaction for a reason. All right. It's being able to bend price for a particular reason. I want to break down what a key point is, a key level is, and why a key level is very, very important to understand when picking a high probability POI. Now, key levels are not just technical levels. All right, it's not just technical levels. They happen for a reason. All right, price is bending from these points to form a lower high for a reason. All right, there's a higher high over here for a reason. All right, these swing highs are not just created because they're swing highs. They're reacting off something. Right, not just technicals, but fundamentals and sentimentals. Every single thing is playing along. Okay, they all respect key levels. So if you're being able to understand key levels, you understand that the higher the time frame, the higher probability the key level is to react from. All right, so back to our storyline. This is GBP USD, and we know USD is the quote, the guy who goes up, and then GBP is the base. Let's say is the guy who comes down. So USD GBP. Okay, let's use the original voice. Now we understand that the base does the bearish reactions and the quotes does the bullish reactions. And now at this point, the US had something on GBP which gave them the upper hand, but GBP has always been a dominant pair for the past 5, 6, 7 years, which is this trend we're seeing right now. But at this point, if you do your research on technicals and fundamentals, you understand that these key levels on the technical points when analyzing are key levels where these stocks had very, very important news. Not just these stocks, these currencies had important news relating to, the quotes and the bears and, every other thing backed on these particular pairs. Okay, so this makes these key levels very important to them, and investors will be looking to bounce off these levels because they know this, the value behind this particular pair values these key levels very, very much. And this is one of the major reasons why support and resistance works. Okay, this is one of the major reasons behind support and resistance. This is where you get the A and the V's from. All right, so if you pay very good attention to key levels, you'll be able to understand and get a higher probability POI because you're always following the trend. Because at this point, you understand that if the trend gets broken, it's going to react off these key levels. All right, reacting off this, we'll be taking out the external low and then retracing back up. Reacting off this will be reaction of the extreme POI and going back down. Taking out this level and reacting off this key zone, we'll be taking out this liquidity. All right, and mitigating a key level, which could be this other block right here. You see how it makes sense with the trend, and we're just pointing out just key levels. So these key levels can actually help you pick out the proper POIs and understand the trend, by just knowing them. Now this is a POI, but it's likely not to last for long because this has already been tested. And you see, this was inducing this POI, this was inducing this POI. This was not what I was drawing in the first place. I was just drawing just trends. But now marking out the key levels has just helped me explain a break of structure here, a break of structure here. Then we had a break of structure, a retest of the trend, a retest of its demand zone, from the previous trend, a break of structure from here, a retest back up. This is a key level as well, because this was a previous key level, which was broken, tested multiple times, and price goes back up to test that. We know this is the next level, next available key level from this point, and the price goes up to react from this, going back down. This is testing premium. And then going back down to take out this low, you know, and retesting it to go back down is also very explainable, you know, and why you should expect something like that. You understand that because of these key levels. So this is how important key level is and why you should know how to use them. Okay, so the Zoom is about to end, and or maybe on our next section, next Zoom, because I'm going to do a new recording now, I'm going to show you guys how to identify these on the live chat. Okay, we have just 1 minute, less than 1 minute left. Once we're done with this, I'll just tap the link again and to take you back here, and we can continue with this. All right. So I hope you're following. Everyone is following up, right?